So I'm going to be honest with you. My entire goal with this course is to make you so confident in this portfolio that this becomes your main investment vehicle. Whether you were previously just putting money into the S&P or gambling your children's college fund on penny stocks, all of those things, you're going to say, I no longer want to do these things because this portfolio is a significantly better way to allocate my capital. If you look at how people invest, right, there's basically, most traders will have two portfolios. One portfolio is their trading account where they're gambling the college fund, and the other one is their retirement account where they're protecting themselves at least, and they're probably just buying the S&P in there. One account, they're swing trading tech stocks. The other account is literally just the S&P. But what are you going to observe when you look at these two accounts? There'll be a couple major differences. Number one is the retirement account has probably significantly more money than the trading account. Trading account, maybe 20K, investment retirement account, probably 100K. Retirement account probably has all 100,000 allocated into a position. Might just all 100,000 be in the S&P or a couple of ETFs, something of that nature. What about this account? The trading account probably has almost all cash and has maybe one or two positions that are struggling to be bigger than $500 to $1,000. A third and final difference is that this S&P account, nobody thinks about it. They just put money into it and forget about it. S&P goes down 1%, they probably didn't even look at the account. On this side, if there's a 5% change or a 2% change in their strategy, you are literally sweating bullets because of it. And when you look at these two over a 10-year horizon, for effectively 100% of traders, the retirement account does better and this one doesn't. And it's because this one has more capital allocated to it. It has a stronger backing for why it generates money over a long period of time. And there's less flip-flopping around, where in this side, it's like, I can only put 5% of my capital in at a time. I can only stick with a strategy as long as it made money today. I can't deal with the stress of ups and downs. Like, there's these two drastically different worlds that most people involved in self-directed trading are involved in. And why is that the case? I believe the only reason this is the case is because people have confidence in the S&P and they don't really have confidence in their strategies. And I think that's just the reality of it. If you had bulletproof confidence in what you were putting your money into and believed it compounded better than the other thing, all of your money would be on that side. And so that's my goal here. I want you to have that level of confidence. That's the mindset that I want you to have when you're running this portfolio. I don't want you to put $500 into this. It doesn't even work with $500. Compounding doesn't matter if it's $0 effectively. It needs to be a machine that you utilize. You need to start with a reasonable sum. You need to contribute money into it. And then you need to allow the compounding to actually play out. So keep that in mind as you go through this course. That is what I want for you. And if you can actually stick with it, it's got a damn good chance of giving you the result you actually wanted all along.